Here we go. On maybe, I don't know, tangential topic, I listened to A16Z the other day, and they say that stable coins are a top 20 holder of treasuries, greater than Saudi Arabia, South Korea, Israel. I can't read my writing of the last one. Have you heard that?
But,
Oh, you don't give a damn. Okay, well, that's
no,
fine.
I don't know what you're talking about. Sorry. What were you talking about?
That stable coins are a top 20 holder of treasuries for the first time. They own more than Saudi Arabia, South Korea, Israel. I'm forgetting. I can't read the other one.
How much? What's the total?
I don't know. I'll post it again.
I
can't
bet
read
you the top 3 holders control 2/3 of the market or whatever
Yeah.
of treasuries.
Huh.
No, it's not that much. The Japanese own the most. They have like $1 trillion. I think the Chinese are second. The Chinese are weird though because they have a lot of holdings that are in the Caymans, so their official holdings aren't as big as the real holdings are.
And then there's the hedge fund community, which I think is also...
then you have the hedge fund community in the Caymans, and then you have the Europeans, basically.
But aren't those basically the whole treasury holding?
I mean, there's 30 trillion. There's 30 trillion of treasuries, right? And 10 of it is T-bills. Most of the T-bills are owned by money market funds, right? Mm-hmm. And so of the 20 trillion that's not bills, it's there's not nearly as much paper as people think there is, to be honest.
Huh.
But going back to Bakes, what you said, I mean, there's this whole milkshake theory out there that relates to the dollar. I think Jeff Johnson is the author of that. And the thinking is that the U.S. government wants stablecoins to succeed, potentially at the expense of Bitcoin, I might add. And the reason they want stablecoins to succeed is because it is backed by T-bills, and you have to buy dollars in order to buy T-bills.
Yep.
Treasuries. And therefore, it meant the dollar as the world currency, which, there's been a not de-risking, but a de-dollarization process going on. So they're trying to fight back on that. Trying to promote stablecoins. It's a strategic.
Stablecoins are 98% U.S. dollar, so it's really bad for the euro, is what it is. The euro is such a good short. That thing is just toast. Like, I can't wait till that's like 90 cents again.
That whole currency turn. I mean, you've been on the British pound, Ben. I've been on the CAD and the euro. They pulled back a little bit here recently, but those have been good trades. For the last month, the long dollar, short CAD, short.
The CAD is a disaster. Canadian economy is a total joke. They need to, what they need to do is they need to get in the drilling business. They got all those minerals and gas and oil. They need to get serious about commodities.
Just at the top of the show here, I'm just going to mention, because it's on the tape, that Atlanta Fed Bostic has decided to retire in February when his term expires. And the reason I think that's important is all the district Federal Reserve presidents I believe are up for renewal in February. And they're, the new appointments come from the district board of directors. I've looked this up, so I now know it. But they are then approved by the Fed board of governors. To the extent that Trump controls the Fed board of governors, and the district president becomes sort of de facto controlled by Trump. And so by May of next year, when Powell retires or resigns or whatever, as the Fed chair, Trump is going to have full control of the Fed. and that has significant monetary implications, obviously. So I think it's important, indirectly that Bostic's decided to retire.
You think that Trump, when he gets control of the Fed, will put a golden Trump statue in there?
Not only if it leads to cost overruns.
Oh, yeah, they got that new Fed, and he's like, "All right, look, I'm gonna green light it, but we're gonna need a golden Trump statue right in the middle when you walk in, with like a big Flavor
Kind of like,
Flav dollar chain around his neck and the
yeah,
statue."
like the Rocky statue at the top of the steps in Philadelphia.
Yeah,
Um,
exactly. But or the Michael Jordan statue outside of the United Center in Chicago.
yeah. Now you got a Tom statue in Foxborough. So
Oh, they have a Tom Brady statue? I mean, they should, but like,
yeah, they absolutely should. Yeah.
that's
Um,
that's when you know you made it, and they got a statue of you. You know, like,
yeah.
all right, let's roll. This is Wall Street Beats. I'm Benjamin Brey, joined by Charlie Peabody and Kevin Baker. Let's keep with with it. It's gonna be Trump's Fed. What else we want to talk about other than banks are going the wrong way for me and you right now?
Yeah. Well, I think what we want to sort of weave a story around the dinner tonight that Trump is hosting for the Wall Street executives. And so if you're a Hamilton musical fan, you want to be in the room where it happens, right, Kevin Bates? I don't know if you know Hamilton, but anyway, in the room where it happens is a great song in that musical. And so tonight's dinner, we can speculate. I've been listening to commentary today. No one really knows what the topic is, so I'm guessing it's going to be wide ranging. But we can speculate that one of the things that Trump has to do is improve his position in the polls, and that may entail, pursuing some populist type, policies similar to what Mamdani has done in New York City. Um, and so I'm going to guess that housing is at least one of the subjects. I mean, there could be talks about immigration, tariffs. There could be talks about capital relief. That's coming. There's a new proposal that's going to come that's going to give relief on the leverage ratio for the banks in the next week or two. It could be on credit cards. Trump has talked about, capping credit cards at 10%. So there are a lot of different topics that probably are going to get discussed. Treasury financing, the deficit, bank deregulation, et cetera. The one I wanted to focus on, because I think there's some, plays here, if you have a view towards, next spring, is, what they're going to do on the housing front, because that is the American dream, to own your own house. And it's very clear that affordability has been a huge problem in housing. And that goes back to, last fall when I started this theme that things that needed to be financed would disappoint. And that has clearly been the case in housing. So what are the things that they can do to address this affordability problem? There are 4 or 5 things that I can think of, and I'll attach some plays to them, and then you guys can chime in as to what you want to say on this front. The first is somehow, at the loan level, reduce origination costs. These are going to be pretty small items, but they're important. So we've seen the credit bureaus, for example, and FICO, make changes to their pricing to reduce the origination cost. You could see, pressure on the title insurance companies, FAF, FNF, to lower, the cost of getting title insurance. So there are things you could do at the origination point, or the loan point, to reduce the cost of origination and therefore the cost of buying a house. Um, you know, Equifax, FICO, Fair Isaac, those companies are starting to see some margin deterioration as a result of the efforts to pressure them to lower the origination costs. And we could see that with the title insurance companies, FNF and AFF. Anyway, so that's number one. The second is to reduce the financing costs. And you're either going to lower nominal rates, and Ben, I know you have some thoughts on how they could do that, or you can reduce the MBS spread because that's over 200 basis points. It's very wide. Um, Or you could, introduce new products like the 50-year mortgage that's been floated. I think the 50-year mortgage float is a non-starter from what I've heard. That's probably dead in the track even before it got started. Um, the reducing the MBS spread is probably going to happen naturally as we end QT starting in December. And my play on that has been to buy Annaly and Agency, and I still own positions in those two companies. Um, and then nominal rates, reducing nominal rates is probably going to be some function of reducing the deficit, tackling inflation, but may also entail, some sort of operation twist or yield curve control. So those are the three things there. We can go back and talk about the ways to play it, but I think Ben's had a phenomenal call with Rocket RKT as a way of playing that. Um, and then the third way is you can reduce housing prices. And there are several ways to tackle that. One is by changing the zoning laws or the local building permit laws to be more builder friendly to increase supply. Um, I will say that the builders have been reluctant to build out because their spec inventory is still at an all time high for the new home builders. Um, but you can also change the somehow you have to incent these builders to build more, and right now they're resisting that. So there are things that could be discussed there, how to incent builders to supply more. And then finally, you could make it easier to do some sort of cash out refi to pay down debt, and lower APRs for HELOCs, for example. Um, so that's another way. And I think is it BETR, Ben, that does a lot of HELOCs. I think that's one of the
Yeah, I
new.
mean they're kind of the same as all these guys. They're just offering whatever. Like Better's like a wannabe rocket. It was funded by Masa's son. They spent about $2 billion in tech spending, so they did a lot of the back end tech. And then we had the 2020 2021 rates come down quite a bit, and they got forced into going to the market, and there was a SPAC. So they took 500 million from Masa for a convertible, but on the condition that they went public, and that was a disaster, right? Chasing that market, and then it just absolutely got obliterated. And then now it's had, when I was talking about that rocket call in July and August, I was saying, Better was if you want to add some juice to your portfolio, and there was some juice there. That thing went from $14 to 90 or something like that.
Yeah, it was a great call. So let me just finish, and then we can open it up to discussion. The last thing, and I think this is probably the most important thing that they can do, is to create a market by using the GSEs to assume mortgages or to have mortgages portable. So create a market for assumable or portable mortgages, and that's going to require the involvement of the GSEs to make that happen. And if we get that, um, type of mortgage market, that's going to be huge because it'll create less friction and increase turnover. Right now, we have the turnover rate is at recessionary levels. To put in perspective, we have 4 million existing homes sold a year, which is a very depressed level, against 133 million households in the United States. So if you take that 4 divided by 133, that's recessionary levels. So it's a very low turnover rate in existing homes. So if you create a market for assumable or portable mortgages, that could really reduce the friction and increase the turnover and home selling. The best way to play that is through the real estate brokers. And I think that's the play for next spring, is to buy the real estate brokers. Now here I'm going to bring in Bakes because he can tell us which one we want to own. But there's Zillow, symbol Z. There's Anywhere Real Estate, symbol House, HOUS. There's Rocket, RKT. There is, what am I forgetting, Bakes? Compass, COM,
Comp.
Comp, COMP. So those are some of the potential plays here that I think people should look at with an eye towards maybe a better spring selling season. as a result of efforts to create a better turnover rate. Anyway, Bakes, do you want to talk about some of those charts on the real estate brokers?
Zillow, for some reason, is the worst. I don't know why that is. That looks like it's rolling over to the downside, albeit on light volume. And I don't know if you have a fundamental reason why that's the case, but Zillow looks like it's taking on water.
I don't have a fundamental reason on that one. Sorry.
Yeah, and it strikes me because when I went through the others, they look pretty good. Here's House Anywhere. I mean, this is a huge gap up, and the volume is picking up. My suspicion that given the long-term history of these things, look at these, that you probably have some shorts that are getting squeezed after 4 years of declines for House. RKT. Every time I listen to the CEO, I like him a little bit more. I just sent you an A16Z podcast, and I just think this guy is building the best mousetrap. I mean, between this and Redfin that he bought, I just think that they kind of win no matter what interest rates are doing. I just think that it's a great story. Comp. See, Compass looks okay. I mean, this looks way better than Zillow. So I don't know what Zillow has going on that's to the negative. And Open, which is obviously ridiculously controversial, and I'm sure has a huge short interest. But Open is Lazarus right now. So
that's the one I bought was Open, just because it fits the meme stock type of market that we're in.
Yeah.
Well,
I mean,
hey, look, don't make any excuses for making money. There's different ways to skin a cat.
Yeah. I mean,
one thing I wanted to bring up is and I think we mentioned this. I mentioned to you, Charlie, when we had dinner in Boston, was Ivy Zellman was on the tape with Danny Moses of Big Short fame, who I'm sure you know, and she said that interest rates really don't matter that much. 70% of housing of the public guys are buy downs, where they take the mortgage rate from 7 down to 4, to 5, and so bringing interest rates down, even on the short end, just doesn't really matter that much because they're already subsidizing the mortgage rates. And I was just surprised by the prevalence of that practice, which she says is unprecedented, and she's been doing this a long time. So, rooting for lower interest rates really doesn't help housing all that much.
Well, that's for the home builders, right? Like that's not for existing home sales, right?
No,
so
okay,
you're talking about new homes.
Yeah, but they, the public guys are 50% of new home sales, so it's still pretty important.
I guess
Thanks. Hold on a second. I think there's one fact I think has to be corrected. You said 70% of all mortgages are buy downs. I think what she said was 70% of all mortgages are under 5%, and then she went on to say that the new home builders are doing buy downs at rates below 4%, and yet spec inventory is still rising, which speaks to your point, Bakes, that rates aren't making the biggest difference.
Exactly.
But I do think if we can get assumable or portable mortgages, that's huge in terms of increasing the turnover of existing homes. So that's different than the home builders. The home builders have to be incented in some manner to build more. But so that's given that Pulte is head of that agency, that oversees the building, I'm sure that he has plenty of ways to incent the home builders that will benefit them as well as the housing market. I actually did buy Pulte homes the other day, so I'm betting that they'll come up with something. Out of the gates, what Trump did was threaten the home builders. But I suspect that threat will turn to incentivizing home builders in some positive way. Sorry, I didn't.
I'm looking at it right now. It's 6% plus is 20% of mortgages. 5 to 6 is 10%. 4 to 5 is 18%. 3 to 4 is 32%, and under 3 is 20%. So, half the market's probably at play by lower rates, which is significant, right?
Yeah.
And so, I guess the new home market. I mean, Charlie, what's the annual new home sales? I know right now they're a little depressed, but like on a normalized basis, what do you think? A couple million a year?
New homes, 100, eight, 700, 600,000. You're talking about new homes, 600,000, eight,
Is
700.
that a month or is that a year?
I think that's the monthly annualized rate.
Yeah, so 4 to 5 million, right? So, but there's like how many homes in America? Like 130 million or something, 120 million, and then 70% of those have mortgages or 65% have mortgages. So out of 80 million, mortgages, it's whatever, it's 8% roughly. So, it's not insignificant, but that existing stock is much more important than the new homes, is all my point is.
Oh yeah, by far, by far, and
Yeah.
that's why I say if you can create use the DSCs to create a market for assumable or portable mortgages. I think Canada has portable mortgages, if I recall correctly. So it's a more complicated, from what I understand, portable mortgages is a much more complicated market than assumable mortgages. Um, but either one would definitely help the turnover, because there is a lock-in effect that exists because people are have 3% mortgages. Um,
Yeah, yeah, yeah. I think it'd be interesting dynamic. I mean, this wouldn't be something I would do, but like if you were now in a market where you could assign your mortgage with the house, I would bet you there's a lot of arbitrage opportunities within homes where, hey, this price has to be reflected for the fact that it comes with a 2.5% mortgage versus this price has a, market mortgage at 630 or whatever, so like you would have price dynamics reflect the liability side of the asset, which would be kind of interesting actually. And I would guess that would benefit the Rocket of the world and maybe Zillow because you'd want to have that data, right? You'd want to have whoever has all the data will be, in a good position, I would imagine. But
yeah,
you know,
yeah. Certainly, in terms of going after market share, having that data would be very helpful in marketing. Sure.
uh, Bakes. What about energy? Our Comstock is at 25, buddy.
Yeah. Jen, you mind pulling, before we go into that, do you mind pulling up the nat gas chart that I sent you, please?
Well, that was the interlude to talk about nat gas.
I like it. Very nice segue. Very elegant. Boy, you can moderate. I've always said that. I've always said that.
He can
Well,
moderate, but he's not
here we go.
moderate.
Here we go. And this has kind of been sneaky, but maybe not to Bob Morris, and we'll talk about it when he's our E&P analyst. But natural gas is at a 3-year high, and this is a pretty compelling breakout, in my opinion. And we're starting to see this with a lot of the gassier names. But I was just struck by I haven't seen a lot of people on CNBC talking about nat gas working off that oversupply and taking out the high. It was 37 in Boston. It wasn't, 17. And so if we get some cold snaps, then you're really going to see nat gas starting to work. I have not liked energy outside of uranium for 4 years now, and that's starting to change. Even Schlumberger on the energy service side is perking up. But what I talked about the other day with, I forget who was on with me, but this is Comstock. And Jerry Jones is an investor here. The Dallas Cowboys stink, but Comstock Resources does not. This is CRK. Look at this. Look at this accumulation here. This is 10 straight up days and above average volume. And, and this is not that, far off the recent lows. Obviously, 25 versus 15 is a pretty good move, but this is really interesting to me. The balance sheet apparently is not to Bob's liking, but I think it's improving. And Jerry Jones has been out there very publicly talking about, this is one of the most exciting natural gas finds that he's seen in a long time. So natural gas is getting positive. The spot oil is still $59. So it is not turned yet. But natural gas names are really starting to perk up, and Comstock, I think, is really intriguing.
The IEA, the International Energy Agency, I think they came out today to revise their peak oil theory. They've been underestimating demand. And if there is a disconnect in the markets, it's that people don't understand that demand continues to grow. And I think the IEA came out today and acknowledged that they had underestimated demand. So I'm a big believer in this space. I'm very heavily weighted towards energy.
The
Oh,
50
but
day has
oil's down 3% today. Did you see that?
Yeah, I mean, oil can't get out of its own way at $59. So I'm not wild about oil, but natural gas at $4.49, whatever the price is. But when you take out a multi-year high like that, I think that's pretty intriguing. So keep an eye on CRK. I'll talk about it more. I'm going to talk about it more with Bob off and online. But natural gas, is integral to the data center story. I know people are sick of talking about it, but it's Chevron was on today talking about AI and data center related projects. So I'm intrigued, and I guess the reason I'm bringing it up is that we've been talking about technology and AI and Nvidia ad infinitum, and people say, oh well, there's nothing else to do. It's powering the S&P. There's always things to do, and Comstock Resources and natural gas is part of that.
Yeah, I think also you got to remember there's a lot of LNG trains coming online between now and 2027. So that's probably actually a bigger demand driver for nat gas in the near term than power data centers. Speaking of
Yep.
data centers, Oracle and Meta continue to have no bid. They are down only, and CoreWeave, they had a terrible print, and that thing's down 16% since 2 days ago.
Who's short
So those are
CoreWeave?
the
Anybody?
I have been for a while. I've been short all three of those, and I
Okay.
talked about it on the show yesterday because I came back. Mike Green was chatting with me and gave me kind of the lowdown on Meta when we were in St. Bart's at Hughes event, and I came back and I was telling everybody, and people are like resistant to it. And now it seems the market is caught up. And if you just look at, I don't have the chart with me, but I talked about it on the show yesterday. The three weakest of the hyperscaler players doing the capex are CoreWeave's the number one weakest, and then Oracle, and they both have big negative free cash flow
Yep.
for the next or trailing and next 12 months, and then Meta will actually have negative free cash flow after share repurchases and dividends, so discretionary free cash flow, and that's they just did a $30 billion debt deal, so the market's clearly saying to people right now, we're not interested in debt funded capex on this stuff. We're re-rating you lower to reflect the risk involved because people can say whatever they want, but I think the ROI on this stuff is very much in question. And so if you're using your own free cash flow, that's one thing. But when you start tapping the debt markets and you're changing your credit profile and you're taking on first lien debt, and Meta did an off debt balance sheet debt as well. So I think that the market's actually acting pretty rationally about that stuff. So we'll see what happens. But you also saw that SoftBank sold their entire
Yep.
Nvidia stake yesterday.
Yep.
So they did that in 2019 also. So that was obviously not as good of a move. But we'll see what happens. This is the second day in a row we've had Meg 7 and tech selling and other stuff getting bid. So it seems like there's somewhat of rotation starting to happen.
Oh, okay. Now your segue is are getting better and better because that's what caught my eye yesterday, and what I also wanted to talk about. Um, you talked about the XLV in healthcare. This is Merck. I mean, that is a pretty chart after a long decline. Look at this, and it's even better this morning than it was yesterday. Above average volume, perking up. The 50-day coming up through the 200, and working off this decline from 135 or so down to 70, and now here we are at 91. But here's the daily. I mean, that is a thing of beauty, in my opinion. So big pharma has been a horrible place to be for a long time, and that is changing. And David Maris, our healthcare guy, has been on fire with just about everything he's done. And Merck is joining the party, which is a Dow component, and the Dow has been hitting highs, and we're not seeing that follow through with the Qs. So I think this is part of the reason for that.
Yeah, I mean, I bought the XBI in May or June at like 76,
Mm-hmm.
and then August 7th, I saw this chart that showed the healthcare XLV relative to the S&P was at like the 25-year low. The last time I was there was in the last like tech bubble, and just bought a big position. So I had both of those, like over 20% position in those two. And because I'm not a healthcare guy, I'll throw something in David's trades here and there, but like, it's such a different space. But I'm totally with you on the healthcare. I mean, look at that XLV. That looks pretty good.
No, I agree. Amgen looks great. AstraZeneca looks great. I won't call them up, because of time, but it's clearly turned. And I can't tell you how many people I listen to on podcasts saying, "Oh, the breadth and the equal weight isn't confirming." Well, I'm sorry. There's other things going up and working. And I think what happens is people, are making excuses here in November as they're going to write their quarter end letters and year end letters. I don't own NVIDIA, or I didn't own NVIDIA or Amazon or Google for these reasons. And, people are going to say, I don't care. I'm still going to fire you. So there we go. I got one more if you get time.
I mean, just one thing on that is I do think healthcare, I mean, we've talked about it, David and I talked about it on the show a lot. Like last summer, I was like, if you looked around and you wanted to be long, it was difficult to find. So it was like healthcare, energy, China, and then bonds and bond related stuff like Rocket. Like in July when I was talking about that, Rocket was $13 stock or something like that. And then, bonds have had a nice move since then. China's re-rated higher. Now healthcare is working, and even energy. The XLE has been trading really well despite oil. You know what I mean? I mean, and nat gas has a big part of that. But so we've seen some catch up in some of those spaces, and I think that those areas are very underowned. So those things can probably, if we do have an actual rotation, those things can keep going because there's just so much capital tied up at the top of the market in tech that it doesn't take much to move out of that, and can just, like your uranium stocks, like it doesn't take much money to make those things go up a lot.
That's why I love them. Oh, to that end, and stay tuned to this space. Silver is 51 plus. If you take out 54, then I think you're really off to the races. Uranium is at 78, and at 84 plus, that takes out an intermediate high, and I think it's going to be a lot of fun. A lot of fun.
I'm bemoaning the fact that I sold my Highcroft mining.
I know. After what, quadrupling your money or more?
Almost a quadruple, a triple at least.
Yeah.
I think you'll be okay. No, I don't think you're going to get a lot of sympathy from the.
But or Bakes or Ben, the one thing Bakes you didn't mention on the energy, you mentioned natural gas and oil, but you didn't mention coal. And I own Warrior Met Coal, HCC, and that's phenomenal. And do you have any? I don't know if you can put up HCC. Do you have any idea of where that could go? I mean, it's new highs, so it's
Symbol again, please.
HCC.
Yeah, I mean, here's the only coal ETF that's out there because they shut the rest of them down. That looks fantastic. Coal's a symbol, and here's HCC. Yeah, I mean, we bottom line is, it isn't just drill, baby, drill. We need everything. We need everything. We need electricity. And you're starting to see it. You're starting to see it become a populist anthem. Shoot the billionaires and shoot the utilities. Because electricity prices are starting to show up on people's bills. But this looks fantastic. I love it. I love it.
Yeah, I mean, you can pull up BTU also. I didn't buy it, unfortunately, but I had a guy pitch me that in August at like $15, $16, and that's the same kind of thing. Looks like it's getting ready. It
Yep.
recorrected a little bit, and then getting ready for the next leg. But yeah, I mean, the point is if you look like at a historical chart of energy consumed globally or in the U.S., we keep going to higher and higher total energy consumed, and like that's the number one driver of quality of life. And so like if you think, I have this great chart that I use when I give the presentations to my grad school students, and I show what drove GDP per capita hockey stick, if you look at like the 700-year chart, because in the Middle Ages all the way to the 16th century, it was just not, there was no productivity, nothing. Well, it was the advent of fossil fuels and then the Industrial Revolution. So more and more power, used to be just wood. Then we had coal, and then you get oil, and then nat gas now, and then nuclear is small and renewables are small, but they're adding. You just want all the energy you can get. I mean, so that's why it's pretty clear that the whole energy transition thing is over. Like that idea is, how's that working for Germany, for example?
Yeah. Yeah, and I digress for a little bit. Those people that say, well, I don't want a nuclear reactor in my backyard. That's okay. They're going to pull as many out of a mothballs here in the U.S. because of that reality. But in China and India, they're just putting reactors up left and right, and they don't care about NIMBY. So it's happening, and we're gonna profit from it. So I got one more, and then we'll go. All right, unless you have some you want to. And this is FedEx, and I haven't seen FedEx in forever. And I don't know if this is an economic indicator or tariffs are off, or I don't know. But FedEx is acting well for the first time in a long time, and I was really surprised as I was going through my charts to see this. So I just put it out there as, again, there's other things to do besides buying NVIDIA all the time, and FedEx is one of them.
Okay. Yeah. Look, yeah, I have no comment on that. It seems like freight and goods are a tough spot, but you know what? Everyone knows that, so maybe it's one of those things where it's been discounted already.
Yep.
All right, let's call it there. I think that's a good place to stop. I'm Ben Brey, Charlie Peabody, Kevin Baker. We are Wall Street Beats. Come check us out at wallstreetbeats.com, and we will see you tomorrow.
Thanks.
Thank you all. Thank you, Jen.
Thanks, Bakes. Thanks, Jen.
See you guys.
Thanks, guys.